Hi everyone, we're just gonna give you a few seconds to get situated, get comfortable, and then we'll begin the broadcast. And if you're a new subscriber or a current new or current subscriber attending today, feel free to share in the chat which services you're subscribed to. If you're an A+ or you're a Platinum subscriber, we'd love to hear. And we hope you guys are having a wonderful week. It's really nice weather out in here in Chicago suburbs, and it's been pretty cool. It actually feels like fall now, so hopefully everybody's enjoying the fall weather wherever you are in the nation. All right, well, we'll begin. So hello and welcome to this afternoon's webinar, Harnessing the Power of Guru Investors, led by John Bajkowski. Thank you so much for joining us. We are happy to have you all here. And so my name is Jenna Brashear, and I'll be your host for today. And we'd like to go over a few things before we begin. So we are very excited to delve into our most recent SSR report, which explores how SSR combines the strategies of four legendary investors, William O'Neill, David Dreman, James O'Shaughnessy, and John Neff, to adapt to market changes, teaching investors how to achieve higher risk-adjusted returns. And I want to remind all of our webinar viewers that AAII is a nonprofit educational group and is not a financial advisor, and thus is not able to give personal advice. Every investor is different. That's why our goal with each broadcast and article is to educate you on how to make better financial decisions. And a handout of the presentation is available under the handout section of your GoToWebinar control panel, which is located on the right-hand side of your screen. And additionally, a copy of the slides used during today's presentation will be sent to all who attended today. And if you have any questions for our speaker during the event, please submit them using the question section of your GoToWebinar control panel, which is also located on the right-hand side of your screen. And then once our presentation concludes, I will select a few questions for John to answer. And then any questions that are not selected for the broadcast will be reviewed and addressed afterwards. And if they aren't addressed, then you can also email those questions to johnb@aaii.com, and I'll put it in the chat later. And if you experience any issues with the audio or the video of the webinar, please consult the instructions on how to change your device's settings, or you can visit the GoToWebinar website for support at gotowebinar.com. And just a friendly reminder that this presentation is recorded and a replay of the webinar will be available later this week on AAII.com/webinars, as well as our YouTube channel. And we'll also include any links to this presentation's handouts and any resources that we discussed today. And for new viewers, we always like to give a little background about our organization. So the American Association of Individual Investors is an independent nonprofit corporation formed in 1978 for the purpose of assisting individuals in becoming effective managers of their own assets through programs of education, information, and research. And with that, I'd like to hand over the presentation to John.
Well, thank you so much, Jenna, and really appreciate everybody joining us today. It's an exciting topic for me. I've been involved with the organization and stock screens from my inception here at the organization. That goes back to 1987. And our objective today is to really just kind of look at, what are our stock screens, why we developed the Stock Superstar service, why we chose to go with 4 as opposed to just one strategy when it comes to putting an approach together, take a look at our performance of the approach, answer any questions you might have about it, and get some ideas out of it. In preparation for this webinar, one of the things Jenna and I did was actually put together a special report that helped to explain, again, a little more detail on each approach that is used by the Stock Superstars report, and also provides an example company from each approach to give you a sense for the kind of companies that match. So again, Jenna is going to be listening for your questions. Just type them into the questions area, and she'll try to stump me as we go along. And that's one of her joys in life, as it is with my children as well. So so with that, I'm going to go ahead and get started here with our presentation. And again, so our objective, just stated, is just to kind of go over what the Stock Superstars report is, the genesis, why we got started, overview of the 4 strategies, look at the performance, and get a sense for what kind of companies pass each approach and how they do. So when it comes to, sorry, my mouse is a little bit jumpy there. We have been examining different techniques for screening really since I've been here. We used to apply them to the shadow stock. We used to just look at gurus, try to get a sense for what kind of techniques, what kind of quantitative techniques that various investors are using to successfully pick stocks. And we decided to go ahead and start to write about these approaches. And it was always an exciting thing for me because I'd go ahead and learn about an approach and try to distill out of some famous investor what kind of rules can be pulled out of their work, be it a book, be it a presentation, be it a speech, that can be developed into a set of quantitative factors, filters, that can identify the kind of companies that a particular investment style, a particular investor would look for when it came to go ahead and finding attractive candidates. Now, again, the point here is that these are our interpretations of these gurus and how they worked. In some cases, actually, we did have some of the gurus come back to us and said we did a great job of capturing the types of things they look for. In other cases, they actually even help us develop some of the strategies. But they do, I think, they might not be the exact companies these gurus invest in, but they're the kind of companies these gurus typically type to look for. And so any kind of performance we track is our interpretation of that as well. And as a member of the association, you have access to all of these screens. And what we typically cover them on a regular basis. Just before I get too far into it, I have given you a fairly large slide deck, a slide deck of probably close to 70 slides. My goal here today is not to go through every slide, but I wanted to give you some background information on some of the approaches that would be helpful for you as a reference guide. And our special report covers these kinds of things in greater depth as well. But as a member, we cover stock screening strategies, and we have always done so. And I've been here, for quite some time, for some, on a regular basis. And we always try to kind of talk about the theory as to why a particular approach has been chosen and the kind of companies they look for. And then, back in the 80s when we developed Stock Investor Pro, we decided to program these strategies, and we thought it'd be kind of interesting to track how they performed over time. And not so much to, I guess, get a sense for, how these strategies interact in different market environments, whether or not they are predictive in some way, because the whole notion of a factor is something that's supposed to be predictive of a stock performance going forward, and how they interact with each other. So this happens to be, in the current journal, I did a look back on our Lakanishak screen, which we programmed. And that happens to be one that Wayne Thorpe developed by looking at the works of Lakanishak in terms of a value investing strategy. But then you as a member can go online and you could view the performance of all these different stock strategies, our hypothetical performance of these strategies, of the buy companies that pass these things, as well as sort them, and you could view that on a regular basis. And it was really those screens that kind of formed as the genesis of Stock Superstars Report. And we thought that the screens were a great way to identify candidates and to get some ideas, but there was some challenges involved. There were starting points, and they weren't necessarily complete portfolios. And I think taking a step back at the shadow stock as an example, when it comes to looking at shadow stock candidates, we buy them when they're very cheap, and they get removed from the portfolio when they become a little bit more expensive. So we might look currently for a price to book of less than 0.90, but we're not going to sell that stock until it's really kind of overvalued or reached full valuation, which is 3 times that level. So sometimes the rules that one uses to find candidates is a little bit different than the rules that are used to sell. And when it comes to tracking our performance, hypothetically, we take a look at the companies that pass at the end of every month. We assume that any company that passes is purchased in equal dollar amounts and it's held for a month. And if it still passes, we still hold it. If it doesn't pass anymore, we go ahead and theoretically sell it. But that kind of turnover, that kind of transaction is not really feasible for an individual investor in a real money portfolio. So our challenge was, how do we take these screens and create not only buy rules, but sell rules? And how do we create the various types of considerations that one needs to look at for effectively managing a tax-efficient portfolio? And really, the other part of the challenge was how do we determine which approach to use? I mean, we have 50 different approaches. Some are based upon gurus, some are based upon well-known factors or considerations. So we try to kind of find approaches that had a good long-term performance, but also interacted in a way that helped produce the overall portfolio. And no matter what, the key factor we found, and when you looked at successful investors, is that discipline was really, really key. It's having a full belief and understanding of the approach you're following, and having the wherewithal to stick through it through good times and bad. And as you'll see, when we present some of the performance, there are times where these strategies go in and out of fashion. And we know, for example, value has been out of fashion as an approach for close to 10 years now. It has decades where it's done well and decades where it's done poorly. It doesn't mean it's a bad approach, but it means that you have to be, if you think it's finding good companies, you have to understand that there will be periods of underperformance. But the riskiest thing and the most dangerous thing that I've seen people do, and we all suffer from this, is really almost jumping off an approach or chasing last year's hot approach. It almost inevitably, last year's best sector, best industry, best mutual fund, probably is not going to be this coming year's best sector, best industry, best mutual fund. Often the qualities that made that particular stock or sector shine in the prior year may not hold true. If it holds true, that's fine. But with a disciplined approach, you want to find rules that make sense, that work across industries, work across countries, that you can live with, and that have true alpha to them as far as outperformance is concerned. So with the Stock Superstars report, what we really tried to do as far as creating it was look at the best approaches and try to take approaches that have done well over time, but then also really have sort of complement each other. They have potentially lower correlations with each other, which means that we are probably limiting to some degree the ultimate portfolio rate of return. Because if you're really, prescient in these things, you could go ahead and pick the best strategy or the best approach, and simply, or the best stock for that matter, and simply buy it and hold it. You wouldn't be diversified at all. But if you could really figure that out in advance, you do best. Diversification, I guess, has this two-edged sword. It does limit your downside risk, but it does also in some cases limit some of your upside risk as well, because you are taking your approach and spreading it across a couple of different styles of investing. But nevertheless, we found this very important to have 4 different approaches. Now, you as a subscriber, you may choose to mix and match, I guess, pick on some that really resonate with you. But for us, we found that it's helpful because we don't know from time to time what's going to be best performing, and they tend to complement each other. And this next slide is, I'm not going to go through the data here, but conceptually speaking, when it comes to looking at the approaches, we take a look at a lot of information. We look not only at its performance, its risk characteristic, how does it do in bear and bull markets, how does it correlate with each other? Some approaches tend to be very similar in nature, so if we added too many approaches that tended to move the same way and were impacted by the markets the same way, they really wouldn't be good diversification bets to the portfolio. So we try to look for strategies that have good long-term performance, both up markets, down markets, yet tend to interact a little bit differently with each other. So when they combine, we're able to reduce the overall portfolio risk. And we found that, generally speaking, even though in some cases we're adding stocks that themselves may have a lot of volatility to them, they tend to move a little bit differently than the other stocks in the portfolio. So as a group, these stocks are all kind of helping each other as far as diversification, yet still have good, attractive opportunities to them. And this particular chart, when you see something in green, that means that the particular strategy happens to be tracking a lot of the index in that particular area, but then some strategies that cancel them just really typically do a little bit different than the rest of the market. And it kind of helps adding that element to them. That's kind of a brief overview as to kind of the genesis of SSR. And I'll be talking more about how we developed it and how we develop the rules, but I thought it'd be interesting to kind of do that by introducing the 4 different approaches we currently have in the system and talk about how the rules were developed, what their approaches are, and then provide some examples of companies that happen to match each of those strategies that are in the portfolio as we speak. And one of the approaches we have, so the service has been around for over 20 years now. And you know, when we designed the service, we wanted the ability to understand if an approach has systematically underperformed or is not living up to its expectations, that there's a way to remove that approach. And by the same token, you know, let an approach that's doing well stay in it. And we have 4 approaches here. 2 of them are actually been around since the inception. The William O'Neill canceling approach, which is kind of a earnings momentum and growth approach, and also the Neff approach, which is a growth at a reasonable price approach. Approaches David Dreman, which is a value contrarian approach, and O'Shaughnessy, kind of a value but factor approach, multi-factor approach. Those are 2 of our additions that have come in when we removed other ones out there. So let's talk about these approaches individually at the moment. Let's talk about William O'Neill approach. And you know, William O'Neill, well known. I first saw a presentation on CanSlim, 30 years ago, and it was it was very interesting to me. I mean, it was the notion of here you have a investor who took a look at stocks that went on to become big market winners, and what kind of factors or considerations that these companies have that they exhibit before they went on to have their big stock market gains. And William O'Neill at that time, you know, Investors Business Daily was the publication that he ran, developed that because he wanted the kind of data that he wanted to look at when it came to buying stocks, very much an approach that's based upon raw momentum. The fundamentals here are earnings growth, both current and in terms of quarterly and annual, price momentum, and overall market direction. There's no valuation elements to it, and it's an approach that's done well in our stock screens, and it's an approach that really has interesting enough done well as far as selecting stocks, and it's always kind of surprised me in some ways. So CanSlim is an acronym to help you remember the factors. So C stands for quarterly earnings growth. You want strong and improving quarter-over-quarter growth. A, annual earnings increases. Now, if you just screen for raw high earnings growth, annually speaking, typically you're going to find companies that are going forward underperform the market. And I think what sets the CanSlim approach apart from most is it looks for year after year increases in earnings, looks for consistency of earnings, companies that are able to boost their profitability year after year, really no matter what the market's doing. That strong kind of growth that is really not just a one-time approach, but is really consistent over time. Stocks hitting new highs in the context of that's markets getting attention on them. The market has taken a note of these companies. These are companies that, in terms of the initial study, we don't really consider this factor right now, had a limited number of shares outstanding. The notion that any kind of small number of boost in attraction will really have that stock price go up. We want stocks that are leaders, that have high relative strength, that are in top industries. You want the best company that represents an industry or sector, not the cheaper second running company. And you want some level of institutional sponsorship. Hasn't really been much of a factor for us recently, but if you go back, I think 40 years ago, it was very important that some of these companies that were sort of up and coming had some analyst following and some analyst supporting them. But lately, it hasn't been really much of a screening factor. And M, which is a market direction. And one of the kind of interesting only strategy here that can potentially be out of the market. And there have been times where no companies are passing and the market's in a confirmed downtrend. And based upon the CanSlim approach, we'll perhaps sell a stock, but we won't buy any stocks immediately to replace it until the market's in an upturn. And we talk about these factors to our subscribers and we give them the tools to go ahead and look at those types of things. Now, the most important, probably one of the most important factors that every investor struggles with, and I'm no different here, is knowing when to sell. And one of the factors of success long term is having a selling strategy in place. And you want to have your rules defined before you go ahead and make your buys. You want to know what's going to make you sell a given mutual fund, what's going to make you sell a given stock, because it's going to become decision time. You're going to really probably struggle unless it's written down, unless you really have a disciplined approach. Whether you're a trader or you're an investor, you have to have a clear understanding of what's going to make you sell this stock at the time you buy it. And I mean, selling is, doesn't get as much attraction and attention as buying, but it is really one of the key factors of good long-term success as an investor. And it's always easier to watch someone else and tell them what to do when it comes on the sell side. We're inundated every day with buy ideas, and we give them to you as members with our stocks ideas. But having that sell discipline is critical. In the case of the Can-Slim O'Neill approach, it tends to be the most aggressive because it has a price momentum element to it. So in this case, we are normally selling stocks when we're seeing a decline year over year in the earnings growth, or if their relative price strength really starts to weaken. And we have highest turnover in this portfolio. It is very much a momentum-based approach, but again, it's part of the approach. And we have different sell rules for each approach that kind of match up with the style of the investor. There are some overall portfolio sell rules as well to help make sure that a stock was purchased, perhaps a mistake wasn't made as far as assessment-wise. But really, it's important to understand why you're selling a stock, and it's important to figure that out before you buy the stock, because you want to have that rule in place. This is the relative performance of the O'Neill Can-Slim approach, and it's had periods of ups and downs. I mean, this year, it's been one of our top performers this year, but it also has struggled at times as far as when you see it in any relative downturn. But all in all, since its inception, we've held it in the portfolio. It's done well relative to the market. But any approach here, and I'll show you a chart later on that has year-by-year performance. There are some years where it's down, but I mean, this has been a great year, and some interesting stocks that are passing currently that are in the portfolio. And these types of stocks, they're not cheap. All these stocks, if you look at the PE ratios, in fact, Hawkins, which is in the special report, it has a value grade of D. It's got a high PE ratio. So William O'Neill was not a believer in valuation factors. So I'm personally probably more of a value investor, and it's always, it's a bit of a challenge for me to look at some of these stocks and say, wow, that's a high multiple. And they're risky because a small change in investor perception, you'll have all of a sudden that earnings multiple contract, and the stock price could be hit pretty badly. But by the same token, as long as these companies continue to perform well, that multiple expands. So again, more information on the O'Neill Can-Slim approach is in our special report, and as well as information on his passing company. But as a subscriber, you have access to the current portfolio. We also produce ideas every week, fresh ideas if you want to get some additional candidates to put into your portfolio if you like a given approach. So the Can-Slim approach is our high growth, high momentum part of our approach, and it's been in there since inception, and it's been quite an interesting performer. I'm going to keep going here, but unless you have any questions that you want answered before we continue on.
Nothing right now, but I'll let you know and I'll jump in if we do.
Thank you so much. So
Thanks.
almost, complete contrast to that, we have David Dreman approach. Now this is an approach that is not one of our original ones. This was added, I believe, was about 2006. The service was launched in 2002. But David Dreman, well-known contrarian, early proponent of behavioral finance, understanding that the markets are not purely efficient, that we don't always act rationally, that we as investors are driven by mistakes. And he pointed out, I mean, even if you're a high PE stock, there's a likelihood that a positive earnings surprise or upward revision is expected. And it's the negative surprises that are really change the perception of a company. And if you're a low, a cheap stock, any kind of positive surprise is really causes people to reassess and is much more attractive. So with the Dreman approach, and we're looking for companies that are sound financially, that are low PE, not the lowest PE, but that are really kind of poised to do well long term. And so, we are typically excluding the small caps. Dreman felt that smaller caps didn't necessarily have the financial resources to bounce back because these could be troubled companies, and they didn't have the visibility. If a company like Nike has trouble and they right the ship, that stock price is going to pop up quickly because investors are watching Nike. And so he wanted the visibility of a smaller. He didn't want the visibility of a mid-sized, larger company. And also, they'd be more closely watched. They'd be more challenging for them to go ahead and trick investors. And again, we're looking at not the lowest PE, but stocks that are having the lowest 40% of all companies. We're looking for companies that are financially strong, that are paying a dividend, that have had recent upward revisions in their estimates, that are on the uptrend. So that kind of helps find stocks that are priced reasonably, but are showing signs of attractive growth going forward. And like anything, it's very important to have a sell discipline. And in this case, if we're buying stocks that have a PE in below the market, once that PE starts to go above the market, 1.2 times the market, that's we let it leave the portfolio. I mean, again, it's important to have that rule in place before you start the buying process. We're looking for fundamentals and to be in place if the market cap moves out of a range. But it's important to really have these rules in place, and we follow them, religiously, and you should have these rules in place as well. So Dreman was added to the portfolio back in 2006, and it actually replaced another value approach. And this is a sign that shows the relative performance. Let me give you a little bit more background. Whenever you see the approach going down, it means it's going weaker than the market is, 500, S&P 500. Anytime you see the line going up, it means for that particular period of time, it's actually outperforming the market. So the approach that it replaced was a value approach. And I was chatting about it today with Wayne, one of the co-analysts here with this portfolio. And it was actually one of our I believe it was our Benjamin Graham approach that we had in there, and it just didn't perform well. Didn't do well. And once we added in this approach, started to do better on a relative basis, and it has been a contributor long term. Like any kind of approach, especially value, it has points in time where it kind of underperforms the market, and points in time where it does quite well. But it's proven to be a solid selector of really reasonably priced stocks that are paying a dividend, are a little bit larger, a little bit more stable, that have had recent upward revisions in estimates, and are priced reasonable relative to their and have good financial strength as well. And so one of the stocks that happens to pass in that portfolio currently is Ingredient. And this is a company that's very very basic. They make items that our food processors use, things like that. And relative to our stock from the O'Neill, which had a value grade, I think it was D, this one happens to have a value grade of B. So with Dreman, again, we're not looking for the cheapest stock. We're simply looking for stocks that are priced in reasonably well, because often stocks with the lowest PEs deserve to have that lowest PE. We rather pay a little bit more for quality and financial strength, and having a dividend that's solid, and having improving analyst visions than simply buying the cheapest stock, because those you actually have to go ahead and watch very carefully, and good chance you might have a value trap in your hands. So this is a good example of the kind of company. It's priced well. It has it's showing good financial strength. It has an A quality rating. So the types of stocks that typically are part of the Dreman approach are dividend paying, more mature companies that have a good track record and are still priced attractively as far as that is concerned. And actually, it's interesting, the ideas list currently, only 4 stocks that are currently passing the approach as of yesterday's data. So, but again, we do typically find trends in industries. Some industries all of a sudden are cheap, and that kind of stuff we do try to highlight when it comes to our ideas list. The third approach that we have within our stock supercharge approach is by James O'Shaughnessy. And again, this is our newest approach. It was added back in 2020. And group 3, we've had a lot of strategies that have sort of fallen in out of favor as far as that is concerned. But before I talk about James O'Shaughnessy, perhaps I should answer a question or two.
We got a couple come in, and I thought it would be a good time to ask you. So one of the questions was in regard to, you mentioned that Dreman actually replaced a value strategy that was originally in the portfolio. So how long was the original value strategy underperforming before you decided to replace it with Dreman?
About 4 years.
Oh, 4 years. Okay.
4 years. And we actually we've changed our approach a little bit back, but we had a methodology. We have a methodology in place. If stocks are passing an approach, but we can't hold them long enough because they're underperforming the market, and all of a sudden the portfolio starts to shrink in terms of number of holdings, we then will go ahead and find a new candidate, a new approach to find that approach. Kind of it's a slow rotation out, but we found it was helpful for us to understand, when a given approach for whatever reason is just not finding candidates that end up doing well. Even with the Dreman approach, Dreman recommends having a 2-year look back. If a stock that you've been holding for 2 years is underperforming the market, and perhaps you miss something on the analysis side, so it's important to really have a reason for selling a stock, even if it's perhaps still priced cheaply, but for some reason you must have missed something and it might be a value trap.
That makes sense. And one of the other questions we received was, for someone who usually shies away from, contrarian strategies like Dreman's, how would you suggest someone familiarize themselves a little bit more with strategies like these?
Well, interesting. There's a couple different ways. I mean, we do cover, we have an in-depth review of all these strategies in our publication. And if you were to even look up Dreman in the AI journal search area, you'd find a lot of articles. We've covered that. But then all of these approaches they've authored books on it. And so, Dreman probably has a half dozen different books that he authored. And I might even have one of my bookcase behind me. I'm gonna move here. So hopefully I'm headquartered. So I mean, I'm not sure if it's the latest edition, but almost all these gurus, and Dreman was a proficient. He used to write for Forbes, and he wrote a number of books. So there's an opportunity for you to read about what they're thinking and see if it jives with you. And that's sort of it. That's one way to become acquainted with an approach, get a sense for if it makes sense to you, get a sense for why this approach might work for you. But it is important, and then you can also paper trade for a while. If you're not really comfortable, nothing wrong with going ahead and just setting up a spreadsheet or going to our portfolio manager on AI.com. Just go ahead and pretend you bought something. Put in one share, whatever it is, put the share price at the time, follow it over time, look what kind of news comes out, look how the volatility is. So you're much better off getting that comfort level of really believing in an approach, because the worst thing you could do is just go ahead and buy 10 stocks blindly, and the first time we have any kind of market crisis or any kind of market activity, you really are struggling to hold on to them, and you sell them at the wrong time. And if you look at typically most investor underperformance, if you look at studies as far as mutual fund performance versus investors that own mutual funds. It's just the fact that they're typically buying these funds after a big run up in price and selling them when they're down. So you really want to avoid selling at the wrong time.
That makes sense. Those are good suggestions. I'll hold off for now with some of the questions. They are very good, but I'll let you get back to your presentation. Thank you
Thank you
so
very
much, John.
much. Pleasure. So yeah, our third approach, and this is one of our newer ones, is a multi-factor approach developed by James O'Shaughnessy. And we've done a lot of work with O'Shaughnessy. In fact, he even helped us develop this particular screen when he was coming out with his latest book that had a multi-factor approach. And if you've been following his work, I mean, at first he developed both a cornerstone value and a cornerstone growth screen. And he tried to find the best single factor that helped identify growth companies and the best single factor that helped identify value companies. And they worked well. In fact, they perhaps were the best long-term performance, but he found that by relying on a single factor, price to sales in the case of value, and really looking at relative price strength in the case of growth, that you would be more suspect to having periods of underperformance. And again, that emotional baggage of having underperforming security or strategy, often would be enough to take you off your game. And so he found that by using developing a scoring system or a way of combining a wide array of fundamental factors, in this case, looking at things like price to book, price to sales, price earnings, price cash flow, shareholder yield, things like these, you're able to actually, perhaps you're able to have a approach that may not have the best ultimate higher rate of return long term, but will have a little bit less volatility year to year and will better guarantee success year after year. So really, it's an interesting way to really do this, and we actually used that methodology first for this to help us refine and develop our value grade that we use on A+ Investor. With the value composite, price to sales, price earnings, enterprise value to EBITDA, price to free cash flow, shareholder yield. And we're simply looking for stocks that are the cheapest, lowest 20%. And when that they no longer are cheap, when they're in the highest 20%, they get removed from the portfolio. But then also William O'Neill, O'Shaughnessy found that it wasn't enough just to look at value. And I think if you are investing regularly in value stocks or small cap stocks, quality is important. Quality isn't necessarily going to find the best candidates, but they'll help you eliminate companies that have poor quality, poor financial strength. Limiting those will really go a long way to actually improving your performance. So beyond value, we have earnings quality, which we try to find companies that are sort of boosting their earnings in odd ways. So we look at accrual things, accounting factors, how to cash, free cash flow, how to cash from operations compared to reported earnings. If you see a big discrepancy, that those companies get downgraded. And financial strength, again. You want to make sure that these companies, because you're buying companies that, on the surface, especially we found with the O'Shaughnessy lower priced value companies, they don't, you might not want to buy them. On the surface, they might not look attractive. How do you make sure they're not value traps? And you have the earnings quality, and then you have financial strength. So you make sure that at least on a balance sheet basis, these companies are reasonably sound. So we look at companies that are cheapest, have strong financial quality, and have strong earnings growth. And this mouse is really jumpy. Sorry. So the Group 3 approach while it did well for the first 4 or 5 years, it then went through a period of generally underperforming. And then so back in 2020, we went ahead and pulled in, we took out what was there, which was sort of, we actually had a couple of different approaches in there over time. Had a price to sales approach, we had a price to sales, we also had an earnings revisions approach that just struggled to really do well on a relative basis. So we put in the, and maybe it was lightning in a bottle, but when this big purple line shooting up, that was when we switched over to the O'Shaughnessy approach. Again, it's value based and it's deep value, and it typically is smaller cap, not by searching out smaller cap, but just so happens a lot of the deep value stocks happen to be smaller in nature. So it is, as far as it's doing amazingly well, given that those approaches, value and small cap, are out of favor. But it's been able to identify interesting candidates that then the market seems to recognize as being attractive. So in the portfolio itself has a lot of names you wouldn't necessarily recognize, but it's I mean, one of the ones that is in our special report is Pathward Financial. It's here you see a perfect example of a company that has very high consistent A's and B's for growth, value, even in this case, momentum, earnings revisions, and quality A. These companies, you may have not heard of them. They may seem troubled, but if you believe in the system and if you have a discipline as far as buying and selling, then we've done okay with this approach. And presents some interesting ideas as well. In fact, we've got a lot of companies, and they vary over time. I've been getting a lot of foreign companies. We try to eliminate anything that's, when it comes to investing in, eliminate companies that are based in China or Russia. I just prefer to invest in companies that you really have a strong financial accounting system. But if you're a value investor and a quant-based approach, this really will sing to you. And the fourth approach has been with a strategy since the beginning as well, is the Neff approach. And Neff, a longtime investor of the Windsor Fund, value fund, wrote a book, during the first growth era of the 1990s, and was upset that at that time value was being ignored. It's a GARP approach. The metric we focus in on is the PEG ratio, but we eliminate to try to control the kind of companies that pass. We look for companies that have strong but not excessively high growth in earnings or in sales. Look for strong financial strength. We look for some yield protection. Reasonable growth, but not too high growth. Cheap, but not the cheapest. And really, we look at PEG ratio is what we really rely on when it comes to the Neff approach. And the PEG ratio is the PE divided by earnings growth. And in there, we add in the yield. And the notion is a company with a high PE deserves to have a high PE if it has the growth and the yield to support that kind of PE multiple. A company that has a low PE, it may be more expensive than a company with a higher PE if its growth is negative or small. So again, it's the notion of you want to have attractive companies, in this case the PE, but it's tempered by making sure that the growth is attractive relative to that particular PE. And we also then eliminate companies that have too low or too high growth as far as that is concerned. Maybe I should use this. So we want some level of yield to help protect the rate of return, and we want good fundamentals as far as cash flow. I mean, cash flow is a good sign that the company is able to pay for things and has some profit margins. And whenever you look at, and screening is an important consideration. How you screen, if you are involved in developing these things on your own. Some screening factors work well across all industries. Other screening factors don't. Operating margins, anytime you do any kind of screen on operating margin, you want to compare it either against the company's past or against other companies in the same industry. I would say the same is true for price to sales. I only think you can really consider a price to sales ratio meaningful if it's low relative to a company's historic norm, relative to other companies in the same industry, because if you're in an industry where profit margins are high, you might have naturally a high price to sales ratio because you're taking every dollar of sales and converting it into a lot of profit. Whereas if you do only convert a small fraction of your sales into profit, and all your other peers do the same, and you rely more on turnover, you should compare it against your peer group. So operating margin, really want to do that relative to industry norms. When it comes to selling, it's, the rules that comes to buying, we kind of reverse it. I mean, if we're looking for stocks that are, relative low PE ratio, once that PE ratio, PEG ratio gets to be twice the market, we go ahead and sell it. If we see signs of earnings distress, if we see signs of estimates that are going bad, and then in a folksy sort of way, when you feel like you're bragging about a stock, it's probably time to sell. Again, it's important to have these sell rules in place when you buy the stock, so you know what's going to make you go ahead and sell that particular security. So the Neff approach has been with the portfolio since inception. It's the blue line here. And again, it's had a strong beginning. It's had strong runs at times when value has been really out of favor. It has had some downturns on a relative basis to the market, but it continues to turn up interesting candidates that have reasonable growth and relative to their valuation metrics, and often are paying an attractive dividend as well. The next slide shows the stocks that are in there, and we'll happen to focus in on Stride, I think one of our recent additions to the portfolio. It's a for-profit educator, does training, has actually gotten a little attention recently. Its stock price started to move up rather quickly. So its valuation in this case is a C, but it has, and its PE ratio is a little bit higher, but it has the historic growth, the expected growth to support a little bit higher multiple. And again, anytime you see any kind of slippage, that multiple relative or its earnings growth relative to the multiple, that would be the kind of thing that would make us want to go ahead and follow the quantitative rule to sell that stock. And plenty of ideas come about this. So we're talking a little bit about the performance of the approach, and this is the long-term performance of the strategy as a whole and of each individual approach. I did the green shading here to indicate how long the strategy has been part of the SSR approach. So anything in green indicates the current group 1 from the inception. Group 2 really started back in 2006. Group 3, 2020, and Group 4 since inception. But the next chart, I think, highlights, the advantage of having a multi-factor or a multi-approach set of approaches in your overall portfolio. And if you are strictly sticking with stocks, SSR does that. I mean, also the importance of having potentially stocks versus bonds, or large caps and small caps and growth value, is that these things run in streaks. For any given year, I did the conditional shading where the green indicates strategies that year that did better than the other ones. The red are the ones that are underperforming for that given year or period. And when you see a streak of red, that tells you 3 or 4 years where that strategy underperformed. Like in this case, Group 4, 3 or 4 years, we ended up, I guess, in that context, switching strategies, and all of a sudden had a streak of outperformance. But even a group strategy such as that's Group 4, which hasn't changed. So you see that in and out of. If you happen to, what if you worst thing you could have done was got rid of strategy 4 in 2020, and only to have all of a sudden do a strong bounce back. And that's the risk of chasing last year's performance. It's more important to have a long-term perspective on that. This chart does a strong illustration of perhaps you are limiting the overall portfolio performance by having a mix of strategies, but then in any given year, and this has been a crazy year, we've had a lot of change in leadership. We've had at times growth stocks lead, at times we've had value lead, at times we've had small cap value lead. and tech at times. And that it's been just like a changing on a dime at times. It seems like all of a sudden, flip the calendar on the month, and all of a sudden, a different approach is in fashion. But you know, the strength of the SSR approach, and I think you as an investor, whether you use SSR or whatever technique you use, it's good to have a little bit of diversification by style, by approach, by asset class. I know you're giving up a little bit of return versus a corner solution, but the important thing is that you don't act at the wrong time. And having a little bit of diversification helps keep you from going off the ledge when it's the most inopportune time. And this is just the relative performance of each approach over time. The black line here happens to be the SSR approach. And you can see at different points in time, different approaches are doing well relative to each other, but they help combine to provide a nice stable return of the approach. And we're kind of getting to the end of our presentation. And Jenna, I know that we put together a special report. Do you want to talk about this before we do questions, or how do you want to handle this?
Yeah, let me kind of give a little highlight about it and explain, then we'll jump right into questions. And I know we have a lot coming in, so we'll try to get to as many as we possibly can without going over too much time, because we respect everyone's time and we do appreciate that they joined us for the event today. But just before we get into the Q&A, I do want to highlight that, and I've been posting in the chat periodically throughout the presentation to share the specific URL that you can use. But the SSR report is available to all current SSR and Platinum subscribers, and will be sent via email later this week. So stay tuned to your inbox. But I also want to say, if you're not a subscriber yet and you want to be, you can visit invest.AAII.com/SSR-special-report, and I'll put that back in the chat again. And basically, we're offering, if you purchase the report for $25 today, then you'll get a complimentary 3-month trial to SSR, so you can take advantage of everything that SSR has to offer. You can take a look at all the strategies that John mentioned. You can look at the portfolio, as well as all of the watch lists as well. So I'll put that in the chat, but I just want to do a really quick call out before we proceeded.
Okay. So time to stump me now, Jenna.
All right, well, let's see. Got a lot of great questions. So let's see where we want to start. Okay, so I think the best question to start with is, we got a few of these in from members. What is the best way to invest in the SSR portfolio for someone who just wants to get started, and relatively soon?
Yeah, I think anytime you invest in any kind of approach, you're better off investing equal dollar amounts for your investments. So I mean, it's sort of surprising. I know we've got some stocks in the SSR portfolio that have a share price of over $1,000 a share, and some that are much more reasonable than that. I know there's just, in the past, people want to invest equal brown lots, but nowadays there's no penalty, and often you're not paying any kind of brokerage commissions. So if you want to invest $10,000 or whatever it is, just divide that by the number of shares you want to buy and try to get roughly that dollar amount in each of these investments. So you want to invest roughly equal dollar amounts, and you could either, again, since there are no penalties normally towards paying commissions or lot commissions, I mean, there's nothing wrong with just buying all the stocks in a given approach or strategy and just getting started in it. If you do want to focus in on just building it up over time, we recommend, if this is your first stock portfolio and you don't have any other equity exposure, I mean, you want to buy typically at least 16 or so stocks. And optimally, they're a little bit in different industries and different approaches to have the benefits of diversification. So let's say if you were doing this in SSR, I guess you want to buy at least 4 from each approach. And in that context, you probably would look at the factors that are most important for a given approach. So in group 1, you might look for stocks that are either showing strong hitting new highs or have strong relative price strength. In group 2, you probably would look at stocks that have low PE ratios. In group 3, you'd look at stocks that have a low valuation grade. And in group 4, you look for stocks that have a low PE to growth ratio, a PEG ratio. But you want to have some diversification, and 16 is, if that's all you have as far as equity exposure, you're better off having at least 16 stocks. That's sort of typically the minimum. We start to really do away with company-specific risk. They say there is no free lunch in the world. The only free lunch, I guess they say, is perhaps diversification, because the market does not compensate you for taking on company-specific risk, or risk that can be diversified away. So there is no equity premium for taking that kind of risk.
That makes sense. And we got a question talking about the SSR as a whole. So how strictly does the SSR strategy, adhere to addition and deletion rules? And what happens to a stock when it no longer qualifies? For example, how long does it take for it, to be removed?
Well, again, it's important to understand that qualifies is different than sell. So a stock may no longer quote unquote qualify because it has a low PE, but it may take a while for it to reach a valuation level where it's considered overvalued and be sold. We actually follow the rules very strictly. We have very specific sell criteria that are unique to each approach, and also we have some overall ones. And so what we do, we review each strategy at least once a month, and we actually have a section called deletion watch list. And so in that particular section of the review, we talk about the kinds of factors that are making us consider, like in group 1, for example, Deckers is on our deletion watch list. The consideration there is that and again, this is not much, but since it's momentum based, it's about, I think it was about 13% off of its high. The market was up, so its relative price strength, and this is since May, was weak. And if its relative price strength from high was below 0.80, it would be sold, and we find a new candidate to replace it. So we are very strict with following these things, but we present, for each strategy, what would make you want to sell this approach, and we talk about it and try to illustrate to you as an investor the kind of considerations you should have when it comes to buying and selling and having overall portfolio management rules.
That makes sense. And kind of a little bit related, but just to kind of get I think a little bit more clarification on the difference between the individual strategies and then also the combined SSR portfolio. Are each of the 4 strategies weighted equally at 20%, 25% amongst the 4, or how does it allocated within the combined?
Yeah, it's a good question. They're pretty close. Some strategies, when they start to do really, really well, they start to grow a little bigger. So it does change a little bit. One of the things we do as well from a risk control standpoint is we will lighten up a position of a given stock if the position gets to be 2.5 times that of an average position. So we'll just simply cut that position down. We won't sell the stock outright, but we will take some profits of that stock and reinvest it in the rest of the portfolio. So they're roughly equally, they're close to being equally weighted, but that we don't keep it that precise over time. But we do allow it, that's typically what would happen is that's when we had a approach would typically be removed, is all of a sudden it's gotten to be too small of a holding, both in terms of size and overall number of holdings. And we think it's time to go ahead and find something more attractive.
That makes sense. And I don't know if you mentioned this earlier, but does the website show the turnover rate of passing companies for each of the strategies? Is that listed anywhere?
We probably, we calculate that, I think, annually, probably. I know we do.
Mm-hmm.
It's funny, it's not that high. It's probably highest in group 1. But I'll go ahead and update that. I know we typically update that at least once a year. But it's the holding period does vary by strategy. Group 1's going to have the quickest turnover. But then we have even some stocks in there that have been held for some time, so it does vary. As long as the stock still matches up with the approach. I mean, you could have a low PE stock that could be doing well as long as the earnings keep growing. Its PE will stay low, or at least attractive. So, but we will go ahead and update the portfolio turnover by both the portfolio and the overall each strategy.
Excellent. One of the questions that was actually interesting that came across is, we talked about a little bit about just the volatility of this year and how, it's been a crazy couple months.
Yeah.
So with all the international turmoil, we did also mention that briefly that in some of the portfolios that there are international stocks, except for usually China and Russia. How do you suggest to members who are a part of the SSR or are going to be a part of the SSR portfolio, how do they prepare for international turmoil? Is there anything that you
Hmm.
specifically would do, or would you kind of leave that emotional kind of decisions out of it?
Yeah, I mean, it's interesting because the the only approach within SSR that would ever go into cash, at least partially, is Group 1. So we are Groups 2, 3, and 4. They stay fully invested all the time. Uh, Group 1, as part of the canceling approach, if no stocks are passing that Group 1 approach, and if the overall market is in a confirmed downtrend, then we wouldn't be adding any stocks to replace sold stocks. I think for me, the best preparation one could ever have when it comes to any kind of stock market turmoil is sort of understanding of history. Is knowing that you're going to have a bear market every 3 to 5 years. Knowing you're going to have a 10% pullback probably at least once a year. Knowing that you're going to have these kinds of, 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 of interaction on a regular basis. And the challenge with that is that most often the biggest down days are clustered near the biggest up days. So if you've had a sudden downturn in the market, and you happen to sell your positions, it's quite often those biggest up moves on the subsequent bull market happen not too far from that bear market, or they're clustered. They happen so quickly that you may not have time to interact. Now, if you have a trend following system in place, that's one thing. You can have your rules set in, but it's important that you have your rules figured out ahead of time. So anytime you have any, and then I've I guess having been involved with the stock market for so many years, my first year, I ended up working here was the stock Black Friday of '87. So I mean, you start surviving a few of these, you understand is that as long as you don't panic, um, and as long as you believe in the overall U.S. economy and the strength of us as a nation, we've always come back. The markets have come back. Um, and just as a follow-up, as far as international stocks, we only buy stocks that are traded in the U.S. So if we have any stocks, they're going to be exchange listed. They're going to be following any kind of listing requirements, any kind of filing requirements that are required in the U.S. You're buying them at your broker, they'll be priced in dollars. So they are going to be U.S. listed.
That makes sense. And let's see. Actually, that answered my follow-up question as well. Somebody had asked about that as well. Actually, this is a great question. So, we talked about the Cancelim stock strategy, stock screen. We kind of began the presentation with stock screens and talking about how, our filtering and criteria, and things like that. So I wanted to ask, one of our members asked, for someone who actively follows the Cancelim stock screen and the O'Shaughnessy's like Tiny Titans and things like that, do you think following stock screens is better, or is following something that's more comprehensive like the SSR strategy? Is
It, it,
are there pros and cons?
it depends on how disciplined you are. I mean, there's nothing wrong. I mean, first of all, we don't follow. We have O'Shaughnessy in our approach. We don't follow the Tiny Titans though. The O'Shaughnessy that we're following is based more, I would say, on the A+ investor grade versus the O'Shaughnessy Tiny Titans. But that's just a minor point if you are a big follower of the Tiny Titans. But if you have the time, the energy, and the ability to again construct a good set of rules and use simply our stock screener, that's it's there for you. If you have developed those rules, I would just make sure you have your buy and sell rules written out. You have your strategy figured out. You have a regular time frame and a frequency in which you check your portfolio. You don't want to necessarily overcheck it. But your portfolio check will probably, depending a little bit upon type of investor you are. If you mentioned following canceling, you're going to have to check that regularly. Those stocks change quite often, and the market changes frequently with them. So if you have those rules in place, I mean, we try to provide you all the tools you need. Our goal is just to give you the tools you need to make decisions. And if you are comfortable enough following a disciplined approach to investing using just our stock screens online, please go ahead and do so. If you want a little bit extra background or understanding of how to build portfolios and how to manage them, that's what SSR is for.
Makes sense. And I did want to ask you, because we spent a lot of time, creating this special report and crafting the content and things like that. Was there anything that surprised you, or that important takeaways that you'd like to kind of share when you were putting this together for our members?
I think the most important thing is just understanding that there's a price for diversification in terms of complexity, but there's a benefit as well. And I think the notion that when things are going well, when the markets are going up, when sentiment is high, it's so easy just to want to follow the hottest trend. But it's shocking sometimes how quickly the market turns. And this is one of those years where, it seems like every 3-4 months, all of a sudden, the market changes direction. And it's so difficult to know in advance what approach, what strategy, what stocks are going to do well. And I wish I had a clear crystal ball that would tell me, where to look tomorrow, and I don't. So I would rather just be able to have a comprehensive approach that it goes across a couple different styles. And I might be giving up a little bit of the returns on the upside, but I'm sleeping better at night, and B, I have a better sense that I'm not going to be missing out on the big trends either.
Makes sense. And we're going to wrap up our Q&A session for now. But if you have questions that were not answered, and they're specifically about the strategy, or something specific about SSR, the portfolio, things like that, you can feel free to message John directly at johnb@aaii.com. And then if you have questions that are more about pricing or billing, or maybe your current subscription, or anything about how to join SSR or Platinum, feel free to email members@aaii.com. And then, John, I wanted to give you a last, if you had any last comments or anything you wanted to leave the audience with.
No, I just, first of all, I want to thank everybody for joining us today. This has been both a passion and opportunity for me here at the association all these years. I don't know if I like puzzles, and I really have gotten, I learn a lot by trying to explain concepts to our members and interacting with our members. So I really do appreciate them joining in and listening in, and I appreciate you, Jenna, as well, for sitting in as well. And you've done a great job moderating, and you do all the effort that you do all the time with the organization. You're a joy to work with, and our members are very lucky to have someone like you and our staff to help produce all the materials that we do here. So thank you so much for moderating today.
Awesome. Well, thank you so much, Sean. And I really appreciate you guiding us through the SSR strategy, going through each guru strategy and model portfolio, and then also giving us a teaser of what was in the covered in the special report. And then also, if you have any questions about purchasing the special report or signing up for SSR, like I said, feel free to email members@aaii.com. And a quick reminder just before we wrap up, got a couple questions in the chat about this, but the special report is available for all current SSR and Platinum subscribers, and a copy will be emailed out later this week. So keep an eye on your inbox, like I mentioned earlier. And then if you're a Platinum subscriber, you can actually access it directly on the Platinum dashboard under the Reports tab. And for those who aren't an SSR or Platinum subscriber yet, we're extending, like we mentioned before, we're extending a special offer to today's attendees. So you can buy the special report for $25 and receive a complimentary 3-month trial of SSR with your purchase. And this basically gives you, 3 months, 90 days to explore everything that SSR has to offer. Like we mentioned, model portfolios, performance, weekly commentary, and then also, those watch lists that we talked about earlier as well. So you can visit invest.aaii.com/SSR-special-report. And they can learn more. Or if you feel more comfortable calling, give us a call. You can call us at 312-766-8874, and that's Monday through Friday during regular business hours. Our member services team will help you out with that. And lastly, I just wanted to mention that this presentation has been recorded. You'll be able to watch the replay later this week at aaii.com/webinars, as well as on our YouTube channel. And we'll provide links to the handout that John put together. It's like we mentioned, it's very robust. It'll give you everything that you need. John spent a lot of time, in effort putting this special, handout together. And then also any kind of resources that we discussed, anything that I put in the chat earlier today, I'll also link that, and that'll be available via email and then also on that aaii.com/webinars page. So with that, we wish all of you viewing good health, good fortune, and a great rest of your day. Thank you and take care. And thank you, John.
Thank you. Thank you, Jenna. Take care.
Take care.